this is really the biggest series of questions we get is all around sort of interest rates, the deficit, inflation, what does it mean for bonds, and then ultimately what does that mean for stocks, which was what a lot of people focus on. This slide to me really just points out the dichotomy that's going on right now, which is on the left-hand side, it's gross government debt. And you can see the U.S. is at 133% of GDP. That means that the outstanding issuance of government debt is about 1.25 times the value of our economy each year. You can see that all these other countries across Europe are north of 100%. Japan's at 200%. So there's a lot of government debt out there, which people will use to argue means that interest rates have to go higher. It's true that there's something known as a crowding out effect, which means that if there's enough debt out there that people are buying from the U.S. government, well, then that's less capital that's available to go buy, let's say, a corporate bond from IBM or something like that. And so because of that, IBM has to have higher interest rates, and it kind of distributes across the economy. The important thing to remember, though, is that that's the theory. The reality is that when you look at Japan has had very, very high government debt for the better part of 3 decades, and they've had extremely low interest rates, often negative and generally below 1% for the course of several decades. And so it's a logical argument that because of high levels of debt, interest rates might go higher, but in practice, we haven't always seen it. The right-hand side also looks at where government bonds are right now in the U.S. and then in Europe. And it's important to remember that there's a huge group of investors out there that have to buy bonds. If you're an insurance company, by statute, you need to buy bonds and a lot of corporate bonds in order to match your liabilities. If you're a government in the state of, let's say, a local government of a city in California, by statute, you have these large reserves of funds that are designed to build a bridge or a road or just fund schools or whatever. You have to buy bonds. You can't go out and buy stocks or this or that. You have to buy high quality bonds. And so there are institutions around the globe that need to buy bonds. They're going to look for what the best return is. And in a lot of cases, the best return is in the United States. So just remember that there is a lot of built-in demand for bonds. Ultimately, interest rates are really hard to predict, and what we found is the best way to protect yourself against rising interest rates is to focus on relatively short and intermediate term bonds because they're not as sensitive to higher interest rates. So by focusing there, if interest rates do go up, you don't risk as much loss of principal. The final thing I would point out is that the single best thing that could happen to any of you if you want to invest in bonds or if you are invested in bonds is for interest rates to go up. It's really strange to say because so much time and energy has been spent talking about higher interest rates and the worry about it really since 2008. I mean, think of the number of headlines on CNBC or in the newspaper, interest rates are going to go higher. But the reality is that if you're invested in bonds and interest rates go up, you just got a pay raise. If you go to work every day and you come home and you tell your spouse that, hey, I just got a raise, that's good news. It's the same thing in the bond market. So as long as your portfolio of bonds, as long as the average maturity there is less than your investment time horizon, you want interest rates to go higher. Because although you'll see the value temporarily dip on your bonds, over time those higher interest rates are going to drag the return up, and you're going to wind up with more return over a market cycle than if you would if interest rates were low. So again, the key here is matching an appropriate average maturity in your bond portfolio, and then honestly, it's sitting at home with your fingers crossed hoping interest rates go higher.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.